Federal Reserve Bank of Atlanta serves the 6th Federal Reserve District, which covers Alabama, Florida, and Georgia, and parts of Louisiana, Mississippi, and Tennessee. Please welcome Dennis Lockhart.
Well, Michael, thank you very much for that introduction, and I want to thank your group for choosing Lowe's Hotel right across the street, the shortest distance I've ever had to travel to give a talk. So I'm going to give a very long talk since I had to travel so short. So thank you for all of that. And it's a real pleasure to speak to your group today. The name of your organization conveys that all of you care about economic growth in our community, and I'm sure beyond our community. The organization's name adds a qualifier, quality. This qualifier acknowledges that you recognize that growth, whether at the local, regional, or national level, can be more or less grounded in sound fundamentals, more or less sustainable, and more or less broad-based and good for everyone. So what is the quality of the economic recovery that has been underway nationally now for more than 7 quarters? To answer that, I will review today the current state of the national economy and outlook. And I will comment on the key drags and risks that could throw the economy off track. A sober assessment of the situation must give some attention to 2 areas of economic activity that are very important to metropolitan Atlanta. They are housing and commercial real estate, and neither is in the best of health at the moment. So a second question: can we have quality growth, a good and sustainable recovery, with these 2 sectors suffering? I will try to answer that question as well. As usual, I am expressing my own views, and which may not be shared by my colleagues on the Federal Open Market Committee or in the Federal Reserve System. Over the last 7 quarters, economic growth as measured by real, that is, inflation-adjusted gross domestic product, has averaged 2.8% per quarter at an annual rate. In normal times, such a pace of economic growth would be quite acceptable. But given the depth of the recession and a loss of 8 million jobs, this recovery has thus far been too slow to substantially reduce unemployment. The cadence of the recovery has been halting. The second half of 2009 was quite strong, followed by a softer but still strong first quarter of 2010. Then the economy decelerated markedly in the second and third quarters of 2010, only to come back a bit stronger in the final quarter of last year. Following a relatively robust end to 2010, however, the preliminary numbers for the first quarter of 2011 showed somewhat disappointing GDP growth of 1.8%. Ups and downs in quarterly growth are, in fact, normal. In the current recovery, the U.S. economy has been buffeted by a number of shocks, significant shocks. Last year, there was the scare of the European sovereign debt crisis. This year, there's been a run-up of commodity prices, particularly oil prices, that translate into higher gasoline prices at the pump. The economy has shown resilience in absorbing these shocks, and they have at times held back the recovery. Despite the relatively weak start to this year, private sector spending appears to have been reasonably solid in the first quarter. Real personal consumption expenditures grew at a 2.7% annualized rate even as gasoline prices jumped. Business investment in software and equipment and software expanded by 12%, actually accelerating compared to the fourth quarter. Exports of goods also posted quite healthy gains. And anecdotal input from many of our business contacts in the Southeast also suggests the economy was stronger in the first quarter than the GDP number suggests. Last Friday's job report showed an encouraging increase in payrolls in April, as well as upward revisions to the two previous months' numbers. Employment growth of the magnitude we have seen so far this year is encouraging, but will still only slowly bring down unemployment in the near term. As I look forward, I expect that the rate of job creation will evidence continuous progress in reducing joblessness. I expect GDP growth the rest of this year and over the next couple of years in the range of 3 to 4% annually. As I noted earlier, this is a relatively modest rate of growth given the depth of the recession and the still high unemployment. Why the relatively modest pace of recovery? Economic history shows that recoveries after a financial crisis tend to be quite slow. A financial crisis damages the credit circuitry of the economy, and repair simply takes time. Financial rebalancing results in a healthier economy in the long term, but acts as a drag on economic expansion in the short term. I also expect a continuing gradual decline of unemployment to a base level that is a bit higher than pre-recession levels. At the gradual pace I'm expecting, it could take up to 3 years to get employment back to pre-recession levels. Now let me turn to inflation. Higher food and energy prices have pushed up headline consumer inflation. The increase in inflation this year appears to reflect pressures that were largely the result of growing global demand and some supply-side or geopolitical shocks. The inflationary impact of some supply shocks is likely to be temporary. In fact, prices of several commodities have either leveled off or declined recently. The latest run-up in the prices of commodities has been a drag on the economy. Consumers and businesses have had to devote a larger share of their budgets to food and gasoline, reducing spending on other goods and services. It's the Federal Reserve's responsibility to ensure that short-run increases in the rate of headline consumer inflation do not turn into a persistent inflationary trend over the medium and longer term. Confidence in the Fed's ability to deliver on this responsibility is closely tied to the inflation expectations of households, businesses, and investors. At the moment, longer-term measures of inflation expectations are reasonably stable. I anticipate that over the next 2 years, inflation will converge to the Fed's de facto inflation objective of 2% or a bit less. This fairly optimistic overall outlook, that is, continued expansion with moderate inflation, is subject to several downside risks. Key risks include, for example, a further spike in oil prices and intensified fiscal pressures or fiscal stresses both here and in Europe. Another key risk is a further deterioration in the real estate sector. And given the importance of this sector to the U.S. economy and the Atlanta region, I'd like to devote the remaining time, my remaining time, to developments in residential and commercial real estate. The residential real estate market remains depressed. In my baseline forecast, the housing sector will contribute only modestly at best to economic growth this year and next. The housing sector impacts economic growth in two basic ways, one direct and one indirect. The direct effect primarily comes through the construction of new houses and production of building materials and household products. Indirectly, the housing sector contributes to growth through its effect on household balance sheets, which can influence consumer spending. Another indirect effect relates to banks' balance sheets and the health of the financial system. To assess how direct and indirect effects will play out, let me provide some perspective on the state of the residential real estate sector. Home sales have not shown any clear trend of improvement since the end of the recession, except for a short pickup during the period of the federal tax credit last year. From the peak 5 years ago, sales of existing homes are down nearly 50% and are close to the 1998 level. New home sales have fallen almost 80% from the peak and are at levels not seen since these data were first collected in the early 1960s. Why such weak sales? There are several explanations. Tougher underwriting standards have shrunk the pool of potential home buyers. Entry-level home buyers, who typically have the weakest credit histories, continue to experience the most difficulty in obtaining mortgage financing. And anecdotal information suggests that this could be a longer-term issue. At the same time, many potential move-up buyers are blocked because they're either underwater in their current mortgage or don't have enough equity to meet the down payment requirements for a new mortgage. The real estate analytics firm CoreLogic estimates that about 23% of residential mortgages are underwater.